Hello everyone, welcome to our Wednesday Q&A. I'm Eric Griffin, President of ITM Trading. With me I have Lynette Zhang, our Chief Market Analyst. For those of you who don't know or are tuning in for the first time, we take your questions that you submit to us via email to questions@itmtrading.com. We put them on a screen in front of us here. We ask them live, so you get a real, organic, spontaneous response.
Absolutely. You know, I never like to prep for this. I just like you to ask me the questions.
That's right. And Lynette's on fire today, so.
Yeah, I've been going
She's
from thing to thing to thing.
to go.
I'm ready.
Right after this, she's going to go right to sleep. All right, Ken W. asks, when Lynette speaks of a revaluation of gold, would the overnight revaluation happen to the spot price?
Yes.
Okay, which would mean it's really a revaluation of the dollar rather than gold, right?
Correct. That is absolutely correct. I mean, gold's main function, in my opinion, is to hold your purchasing power intact. So with the central banks suppressing gold so that you don't understand what's really happening to the currency, Ken, you are spot on.
All right, well, that was the easy one.
Yeah. Do we have a hard one?
I don't know. We'll find out. Dave Q asks, do you see a possibility of the Chinese economy crashing so badly that China is forced to sell much of its enormous gold reserves?
I don't know that it's the economy crashing so badly because, you know, they did just add, surprisingly, I mean, China does not really report on its gold reserves very often. And I do wonder if even when they do, how accurate those numbers are. But they did just add to their position 1.6% that they just reported for the first time in 3 years. I don't see them having to use their gold reserves necessarily because their economy is crashing so badly, because we have to keep in mind that this is going to be a global crash. We just had, and for the first time ever since they started tracking this, a globally inverted yield curve. So it's not just China. However, what we also saw in 2020 were a number of countries that used their gold reserves to make it through. So gold is kind of a savings. I don't think that they're going to be forced to sell much of their enormous gold reserves. They may need to use some, as all countries will have to do it, at least those that have some gold, to survive this when nobody will accept their currencies. So I'm sorry, I'm kind of talking in circles on that one because I was thinking at the same time. I think we're going to see this happen on a global basis, number one. And if nobody trusts the other's currencies, they will trust gold. So I don't think it'll be limited to China, but it may also let us know who actually has gold and who doesn't actually have gold. So it'll be really interesting. That's a great question.
All right, so Barbara H. asks, you said you took out a mortgage for your bug-out home.
No, I tried.
Right, you tried. But you are on a seller carry, though, so it's a sort of a mortgage, right?
No, I paid it off.
Oh, no.
I had to pay it off. It was only a very short term.
It's like a bridge
It was just a little bit of a bridge.
Got it.
But I do have a mortgage, small mortgage, on my house here. So we can
just say that. We can just say, so you have a mortgage on your house here.
Yes.
If there is a reset, won't you owe a lot more dollars on it?
No, I won't, because I have a fixed rate mortgage for a long period of time, 15 years or something like that. But I don't think I have that much left. However, part of the strategy is when they do the revaluation of the gold and it goes up, I grab some of that gold, convert it into dollars, and pay that mortgage off with dollars that have no value. But the amount of dollars I owe on it, this is an advantage that we have, right? For those that have long-term mortgages, if I pay it off before they do the revaluation, I'm not going to owe any more dollars because I'm going to, boom, pay it off like that. Which I could actually do right now, but I don't want to because I want to execute the strategy.
Right.
Rather put that same money into gold.
As long as they don't revalue your mortgage, right? If you had a $100,000 mortgage, if hyperinflation kicks in, you can always, there's more dollars, easier to pay off that debt.
Exactly.
As long as they don't readjust
and they are
the
going
value of your mortgage.
They are going to do that, but history would show that it happens during that same period of time when they're revaluing the currency. They can't, well, I shouldn't say that. I have to read the details. But I don't believe that they can just automatically revalue my mortgage. I think that happens, historically, that happens during the revaluation process, and then they'll put like a variable interest rate on the new mortgage, which is going to carry as we go through the hyperinflation. That's going to go up, so that's going to add a lot more. But I'm not going to be subject to that, nor would anybody that builds their position in gold now, because when they do that revaluation, what might take 10 ounces or 30 ounces or whatever, however many coins, because not so much in ounce form right now, might only take a fraction. Most likely it's only going to take a fraction of that. That means I'll get to keep a lot more of my gold. But yeah, that's it's part of the strategy, is to boom, just pay that off with dollars that have virtually no value to them.
All right, so William H. asks, what will happen?
Well, I just kind of read ahead a little bit. Sorry.
That was hilarious. What will happen? Oh.
I'm sorry.
It's like, what? What is happening? All right, what will happen to my annuity with the reset?
That's why I said that.
I have substantial money in a 10-year annuity with a life insurance company that was set up to provide me with an income stream into the future.
So you want to make sure that you watch the video, the one that I did yesterday on the biz. And the reason is because our perception, especially when you have, an annuity. Now, you don't say whether this is a fixed annuity or a variable annuity. However, either way, we think that the insurance company took that money and then invested that for a long term, so that when you're ready to retire, that money will be there to pay you. But the biz report that just came out, Bank for International Settlements, was talking about how the insurance companies, pension plans, and others that are kind of financial institutions but non-banks have, number one, gone very short term on their investments. So the perception is that they have long term, but in reality they've gone very short term, and there is a maturity mismatch. So, and a lot of that money, in an effort to increase yields, because yields have been held down for so long, are put into derivative products. I don't have a 10-year or even a 1-year. I don't have an annuity, period, because I'm quite clear on where we are in this trend cycle. I mean, first of all,
what would happen to a 10-year annuity in a hyperinflationary environment?
They have no value.
Because I don't know enough about annuities. I also don't have one, but it would seem like, are the annuity payments guaranteed and fixed? Typically they are, aren't they?
Well, okay. There's two different kinds of annuities.
Hyperinflation would erode that.
Well, the hyperinflation is going to erode it, or any asset that all you can get out of it are dollars. When the dollar has no value, look at Zimbabwe, you've got billionaires that can't afford eggs, right? So it's not how many pieces of paper or what the numbers look like, it's what you can convert those numbers into. So 100%, as we go into hyperinflation, all the value that you're holding in the annuity purchasing power value goes away, period. But on top of that, the risk that these companies that we think of, and you said guaranteed. Well, read your fine print, because it is based upon the claims paying. These are the words in these annuity contracts. It's based upon the claims paying ability of that annuity company. So if they can't pay you, they are not paying you.
Right.
And because of all of the Federal Reserve and central banks' manipulations with the interest rates, where in the past, if they had an annuity that they calculated was going to pay out in 20 years, they'd put a chunk of that or most of that into 20-year paper. And then that payout would be guaranteed. But because since 2008, interest rates have been held at zero, that has forced these insurance companies to take on a lot more risk, go a lot more short term, and put your savings at risk. And seriously, follow the link on the Bank for International Settlements report that I just did yesterday and read that report. You got to do what you're comfortable with. I can't really tell you what to do, but I can say I personally don't own an annuity. I understand them. And if it's a variable rate annuity, then it's tied to the stock market and it becomes fixed once you start to annuitize or take payments, right? So if it's a fixed rate, then you can anticipate the amount as long as the insurance company can actually pay you. I'm not sure that that's going to be true, and neither is the biz. So I'm sorry.
All right, so Zach M. asks, let's see. Will America do a bankruptcy, write off the entire debt, and then start with a new sound money system backed by precious metals?
Well, hyperinflation is a way that a government basically declares bankruptcy and writes off the entire debt. So I do believe we're going into a hyperinflationary depression, and they will be forced to start with a sound, where it'll appear to be a sound money system backed by precious metals, but on average. So we're not going to know this until this actually happens, okay? But there will be on average at least 3 overnight revaluations before we go on a more sound monetary system. They most likely will not back the currency 100% by precious metals. Plus, we don't really even know how much we have. We can, it hasn't changed by even a 1/16 of an ounce since I think 1952 or something like that. Ultimately, though, once all confidence is lost, in order to get the population to accept and use the new currency, they will put a component of gold in it. And they have at the IMF, they have talked about putting a component of gold in the SDR, which is what I think is most likely to be the new world reserve currency. But it's not going to be so easy for the population when all of this goes down. That's why you got to have gold. And that's why I think central banks through the third quarter of this year have bought more gold than ever since they started tracking it, because they well know this whole system it's already deteriorating. The foundation is crumbling. And we can see that, I think most clearly through the government debt market, the sovereign bond market, which I did a piece not that long ago on, and I've talked about this actually quite a bit over the years, on the lack of liquidity in that market. So that is really what's telling you this whole thing is on a house of cards and it will implode.
Do we lose it again?
No,
It's just giving you a warning.
Okay.
I saw that big yellow banner come up. I was like, oh no. All right, DG asks as a live question, can you paint a picture of how society will look when you are planning on bugging out?
Is it okay if I let them know when I'm headed up to the cabin?
What do you mean?
You're going to let me? Well, can I paint a picture of society?
Is there, why would I not let you let him
Right,
tell
I don't
him?
know. I mean, I don't even know why I asked you. Please forgive me. I'm really actually very tired. But I will let you know when I'm bugging out. But society is going to get very local. When the death knell actually hits, I think it'll probably take roughly 6 days before the normal population really knows it. And the way that they're going to know it is that the grocery store shelves are going to go bare. They're not going to be able to put gas in their car. So when we have this next Lehman moment, that's really what I'm looking for. And I will be headed up. And everybody in my little entourage that's going with me, no, don't question it. When I say I'm going up there, you get your butt up there. It's going to be very ugly. You know, I put in all these security shutters on my entire house, as well as security gates, because I don't know how long I'm going to have to be up there. But desperate people do desperate things. So I think there'll be a lot of rioting. There'll be a lot of looting. People will,
Dystopian.
devolve. Yeah, dystopian. It's not going to be a pretty picture. I'm sorry. But, I will have lots of food available for people. I hope they just don't destructo everything. But if they do, I can rebuild it. So they're not getting in my house, though. Nope. Nope.
All right. Well, so didn't you say that you had Gerald Celente on today?
I did, and
When do we air that?
Tuesday.
Tuesday. Okay. Yes, I had my very good friend Gerald Celente, and who I just love that man. I just love him. And I think that was probably the very best interview that he and I have done together. Unfortunately, we talked a lot about World War III, and he's got a solution that I think makes a whole lot of sense. So you don't want to miss that interview. And make sure you watch tomorrow's video on the global inverted yield curve, because I've been talking about the yield curve inversion that really started the beginning of this year with the 20 and 30 year, and then kind of worked its way through. But this is the first time that the yield curve globally has actually inverted since they started tracking it. That's not a good thing. I mean, it's not a surprising thing, but there's nobody that can pull us out. Like China used to be able to do that just by taking on more debt and building cities that nobody was going to live in. I mean, come on. But you've got to do that. And yesterday's video, if you have not watched that yet, I'm going to encourage you to watch it and also to go and read this report for yourself, because I've said forever that the derivatives are going to be our undoing. And the Biz just came out with a report on December 5th on basically saying, we're seeing the tip of the iceberg in foreign exchange derivatives, but that there's $2.2 trillion in foreign exchange derivatives that are in jeopardy of not settling. In other words, counterparty risk. You and I make an agreement and you back out, because I would never back out. But no, I'm only kidding. But you can't settle that transaction. 2.2 trillion a day, and they anticipate somewhere 65 trillion, 85 trillion, but this is notional value, which means, and they say this, they have no idea. This is an estimate, but they have no idea. And this is a ticking time bomb. So if you haven't watched that yet, watch it. If you have watched it, you might want to watch it again, but totally follow those links. And if you haven't done this already, you definitely want to subscribe, because there's so much information coming out you need to be aware of so you can make those educated choices for yourself. And if you haven't done this too, you need to have a plan. So click that Calendly link below, have a conversation with one of our consultants where you put your best interest first, starting with your goals. And if you need help establishing those, we are happy to be of service. And if you like this, please give us a thumbs up. Make sure that you leave us a comment and share, because ignorance does not make us immune. It just leaves us vulnerable, and I don't really want anybody to be vulnerable to those vultures, those really disgusting, I'm sorry, humans that they have to be sociopaths, because they can't go to sleep knowing what they've done to most people. So until next we meet, please have happy holidays, stay safe, and I'll see you next time. Be safe out there. Bye-bye.